Welcome back to the Mortgage Business Weekly. I'm your host, Dr. Dalton Jones, Mortgage Loan Officer with Loans by Jones, powered by Morty. We've got a great episode for us today. Let's go ahead and get started. Today's episode is Breaking Lending Barriers with Business Ratios and Asset Depletion Leverage, a practical guide to understanding how business expense ratios and asset depletion strategies can unlock more qualifying income for our self-employed borrowers, our business owners. Let's go ahead and get started.
Housing
So
lender.
the difference a ratio makes. So I'm going to provide a scenario and explain the different qualifications and the extension of purchasing power that comes when you utilize a representative like myself or any of our team members at Loans by Jones through the lens of a broker. So let's consider a self-employed borrower, a contractor, who's doing quite well, bringing $24,000 in average monthly business deposits. But at the same time, he is breaking even at about $24,000 in monthly expenses. Here's how an expense ratio through expense deduction can change qualifying income and borrowing power dramatically. So your standard local shop here, you've got your $24,000 in positive deposits, $24,000 in expenses. The standard expense deduction from most local shops is 50%. So 50% of 24,000 is now 12,000. 24,000 in monthly positive deposits minus 12,000 in expenses now becomes 144,000 in annual qualifying income, 12,000 times 12. Now, he's still doing a great job. There's still great offerings at that annual qualifying income. But let's take a look at from the perspective of utilizing the lenders partnered with Loans by Jones, who in some cases can go down to even 10%. Yes, 10%. But for the example, I did use 15%. Same business owner, self-employed contractor here, had his positive 24,000 monthly deposits, but of course had 24,000 in expenses. The deduction of 15% compared to that 50, $3,600. $3,600 compared to $12,000. Well, how does that look like when it comes to qualifying monthly income? Well, instead of 12,000, 24,000 minus 3,600 is 20,400. On an annual basis, that's $244,800. Same borrower, same deposits, same business. Over $100,000 difference in qualifying income simply by using a smarter, more accurate expense ratio methodology. In addition to, there are situations where borrowers do have income tied up but have a larger investment balance retirement account that we can also use for qualifying income. Really fantastic. So a quick hypothetical here. Let's say a higher net worth client, Mr. Robert, he's got a $300,000 401k. A typical local lender, he was unable to receive a potential product, it sounds like, because he was short anywhere between, $1,700 and $2,500 a month. So what happened at his local shop? The result, he was denied. Well, through products and through lender partnerships that Loans by Jones, powered by Morty, have and can offer to our clients, there are opportunities as well to leverage those 401k options. So for Mr. Robin in our example, 300,000. Typically, we'll take a 50%, sometimes 40, sometimes 60, but then we'll divide it by, I used 84 months and 60 months in this example. We have various lenders at different options. But for an example, in addition, because he's worked hard, he's saved for his retirement, and he's accumulated those assets, we can now include with that additional anywhere range between $1,786 and $2,500 a month just in this example. So an incredible additional opportunity for our borrowers to increase their monthly income. And as it says here, the result, Mr. Robert, the hypothetical example here, got denied from a local shop, but would be able to get approved here at Loans by Jones using the same assets he already had with no liquidation required. And so, just in summary here, the Loans by Jones advantage: self-employed borrowers, high net worth clients, first-time home buyers all deserve a lender. Everyone who understands their full financial picture, not just what your tax return says. So here's really what sets us apart, and those include that business ratio flexibility for our business owners, self-employed borrowers, and that asset depletion income. And of course, I always want to make sure to present my information here, my email, my contact info. If there's ever any questions, please don't hesitate to reach out. This is a learning seminar, a learning masterclass, completely free. It is for educational purposes only. And I always suggest please consult a tax advisor for direct tax advice. And the sources, the references here, great information if you guys want to read that. But they are not APA standards. Some of them are beyond the 5-year gap. So I just wanted to make sure to include that. But either way, thank you again so much for tuning in to this week's Mortgage Business Weekly, talking about business expense ratios and asset depletion leverage. I'm your host, Dr. Dalton Jones, and we will see you next week.